What if I told you the collapse of America's used car market has already started, but almost nobody's talking about it? Not in boardrooms, not in the headlines, and definitely not at your local dealership, where smiles and sales talk mask something much more sinister, a complete unraveling of the car economy as we know it. One company has accidentally exposed the truth. CarMax, America's largest used car retailer, just waved the white flag, not with words of apology or defeat, but with silence. Their leadership flat out refused to issue future guidance. They didn't say sales might slow. They said, we don't know what's coming next. This is the most data-driven company in the industry. They have real-time access to hundreds of thousands of vehicle transactions, detailed credit behavior, and consumer demand curves. If anyone could predict what happens next, it should be them. And yet, they can't. So what does that mean for the rest of us? It means the storm that's been building for years is finally hitting. And what happens next could reshape how Americans buy, finance, and even think about cars. Inventory is piling up. Financing is drying up. Buyers are vanishing, and millions of vehicles are quietly losing their value faster than anyone expected. CarMax isn't just another used car dealer. They operate like a financial institution, a logistics company, and a tech firm, all rolled into one. Their systems track lending trends, purchase behavior, and pricing shifts in real time. That means when something breaks in the car economy, they're the first to see the tremors. Their silence wasn't just corporate caution. It was a flashing red alarm that the data no longer makes sense. It's like the weather satellite going dark in the middle of a hurricane. What started with a missed earnings call has become the biggest red flag in the automotive world. And if you're not paying attention, you could be the next person stuck holding a car you can't sell, can't trade in, and can't afford to keep. This isn't just about CarMax, this is about survival. CarMax didn't just have a bad quarter, they had a meltdown. In a single day, nearly half of the company's market value vanished, $3.2 billion, gone in the blink of an eye. But that wasn't even the most disturbing part. During the earnings call, CarMax leadership didn't just revise their outlook, they eliminated it. The CEO came out and said, "We can't predict what's coming next." For a company that prides itself on data, forecasts, and operational precision, that's not a cautious move. That's a full-blown surrender. And when a giant like CarMax throws up its hands, you better believe the rest of the market is holding its breath. This isn't just about one company struggling, it's about the cracks forming beneath an entire industry. Because if the most advanced, well-capitalized used car retailer in America can't figure out how to navigate this market, what chance do the rest of us have? Let's get one thing clear. CarMax didn't get here by accident. Their problems started long before this earnings disaster. For months, they've been watching vehicles pile up on their lots, cars they can't move, can't finance, and can't sell at a profit. Their business model, built on velocity and precision, has hit a wall, and it's not just them. Carvana dropped 12%, Vroom 18%. Even traditional powerhouses like AutoNation and Lithia are bleeding. Dealers across the country are feeling it. They're slashing headcounts, canceling vehicle orders, and quietly selling off inventory just to stay afloat. And the squeeze is happening on both ends. One buyer shared how they were pre-approved for a car loan a year ago, only to be rejected for the same loan today, despite a better credit score. Another said their dealership insisted on 20% down just to qualify. It's no longer about trust in the borrower. It's about fear of the lender. The risk has shifted, and when risk shifts, the middle class gets locked out. But that wasn't the whole story. Let's talk inventory, because that's where the rot begins. CarMax loaded up on high-margin SUVs and trucks in the $25,000 to $35,000 range. The plan was simple: ride the wave of post-pandemic demand, but that wave crashed, and fast. Now consumers want affordable transportation, not luxury trims with oversized monthly payments. Here's the twist. CarMax doesn't have the cars buyers want. The $15,000 commuter sedans, they're either too damaged to resell or no longer in stock. They bet on the wrong end of the market, and now those bets are sitting idle, bleeding value by the day. Each car sitting unsold racks up holding costs, financing fees, depreciation, insurance, space. Multiply that across hundreds of locations in tens of thousands of units, and the math gets ugly fast. The ripple effect? Even buyers with decent credit are walking away. Why pay $700 a month for a car that'll be worth half that in a year? Now here's where it gets worse. Credit markets are tightening. CarMax has already started raising its approval thresholds. Minimum scores went from 580 to 650. Debt-to-income caps dropped from 50% to 40%. Their in-house lending arm is slamming the brakes on approvals, and it's not just them. Banks are pulling back, credit unions are freezing applications, And even auto manufacturer lenders are quietly raising rates. Repos aren't just piling up. They're flooding the wholesale auctions. Tow yards are running out of space. Auctions are cutting bid floors just to clear inventory. And every time a car sells below value, it drags down the price of the next 5 like it. Dealers are watching their inventory values collapse while holding debt they can't cover. It's a vicious cycle. More repos mean lower prices, which leads to more underwater loans, which then become the next wave of repos. What does that mean? It means a growing segment of potential buyers are being pushed out of the market completely. Defaults are already spiking. The 2022 and 2023 loan vintages are failing at rates 40 to 50% above projection. That's not just bad luck, that's structural decay, and it's hitting hard in key markets like Florida, Texas, and California, states with massive car buying populations that now can't afford what's on the lot. Even worse, lenders are starting to scrutinize every deal. Buyers with stable income, long histories, and high scores are still being declined. Not because they're risky, but because the market itself is. And while CarMax was busy blaming tariffs and global economic uncertainty, the truth was buried in the numbers. Their same-store sales were already falling last year, months before tariffs went into effect. The cracks were there for anyone willing to look. High prices, loose credit standards, and the wrong inventory mix were setting the stage for disaster. The tariffs just added gasoline to the fire. Publicly, the company said import fees were disrupting the new car market. But CarMax doesn't rely on new imports. They specialize in used, mostly domestic and off-lease vehicles. So what's really going on? They're trying to shift the blame, plain and simple. Because owning up to a strategic failure is harder than pointing fingers at Washington. Instead of fixing the problem, CarMax went into survival mode. They started experimenting, rolling out subscription models, testing rent-to-own platforms, and freezing long-term expansion plans. They began pulling cash back from markets, quietly shuttering underperforming locations, and laying off staff. Why? Because internally they were preparing for one of 3 outcomes: a soft landing, a hard crash, or a full-scale financing collapse. This wasn't about earnings anymore. This was about avoiding extinction. At the same time, their competitors were watching. Smaller dealers began to panic. Without CarMax's capital cushion, they couldn't afford to wait. Many started dumping inventory at a loss just to stay liquid. The wholesale market went into free fall, and suddenly everyone was underwater. Car buyers, sellers, lenders, and manufacturers. CarMax saw it coming. That's the scary part. With over 750,000 transactions annually and operations in more than 40 states, they sit on an ocean of real-time consumer data. Their insight into shifting trends isn't theoretical, it's forensic. And what they've seen is alarming. Subprime defaults are exploding. Prime borrowers are scaling back. Even buyers with 700-plus credit scores are choosing cheaper cars and delaying purchases. That's not a blip. That's fear. Buyers who once qualified for $400 monthly payments are now asking for $300. It's not just about rising rates, it's about shrinking paychecks. Inflation is eating into disposable income, and for many households, the car payment is now the first to go. That's not just a company issue, that's a macroeconomic fracture. Meanwhile, used car lots are turning into storage yards. Across the country, dealers are reporting record-high days on lot. It used to take 30 days to sell a car. Now it's 60, 90, sometimes 120 days, and climbing. And with interest rates on floor plan financing more than double what they were 2 years ago, every unsold car becomes a ticking time bomb. That's why repossessions are stacking up faster than ever. Recovery companies can't keep up. Storage yards are overflowing, and every car that hits auction drops the value of the next one. It's a feedback loop of destruction. CarMax's operational transformation may have actually accelerated the collapse. They've gone all in on AI, real-time pricing, predictive buying, digital financing. Their systems can undercut competitors by thousands, flood the market with inventory, and scoop up the best used cars directly from consumers. Their reconditioning centers now operate like manufacturing plants, turning cars from acquisition to frontline ready in just 3 days compared to 10 or more for traditional dealers. That efficiency is crushing the competition, and it's driving a wedge through the used car ecosystem. CarMax didn't mean to destroy the old way of doing business. They were trying to survive, but their success is now collateral damage for an industry that couldn't keep up. This isn't just an automotive crisis, it's a consumer crisis, because transportation isn't a luxury, it's survival. It's access to work, to healthcare, to family. And as financing dries up, more people are losing that access. In rural and suburban areas, public transit doesn't exist. Cars are the only option. And now that option is slipping away. At the same time, manufacturers are retreating. Ford is prepping to slash 15% of its dealer network. GM is scaling back production. Stellantis is considering importing ultra-cheap cars from overseas to stay relevant. These aren't tweaks, they're structural shifts. The entire ecosystem, from automakers to auction houses to lenders, is being rewritten. So where does that leave the average person? In a market defined by chaos. If you own a car today, its value may plummet over the next year. If you're looking to buy, you're stuck between rising interest rates and falling loan approvals. If you're trying to sell, you might be competing against a flood of repos that slash prices overnight. And if you're a dealer, you're either adapting or exiting. Because this isn't about surviving a tough year. This is about surviving a reset of the entire American car buying system. CarMax's warning wasn't a fluke. It was the canary in the coal mine, and the mine is filling with smoke. So if you're watching this thinking, this doesn't affect me, think again. Because when the largest used car retailer in the country can't forecast its own future, that's not a forecast, it's a forecast failure. The storm is here, the map is blank, and the road ahead, it's crumbling beneath the wheels. Hey, before you click away, do me a quick favor. If this opened your eyes even a little, tap the like button so more people can see what's really going on out there. And if you want to stay one step ahead of this unfolding mess, hit that subscribe button. I break stories like this down in real time so you don't get blindsided. Also, drop a comment below. Are you buying, selling, or just riding it out? I go through them all to get a real sense of what people are actually facing. So stay sharp, because it's only just beginning.